Wow, this is crazy. Okay, let's dive right into this explainer. Look at what is happening in the semiconductor market right now. We are seeing some of the absolute most insane stock price fluctuations in recent market history, and one company is sitting right at the dead center of the storm, and that is SanDisk. Just yesterday, global tech and memory semiconductor stocks saw a massive coordinated plunge. That plunge threw a huge wrench into what has essentially been a relentless one-year upward trend. The market is completely divided right now. You have half of Wall Street screaming that the AI bubble is popping, while the other half is aggressively doubling down on AI infrastructure investments. So what is really going on behind the scenes? To cut through the noise, I am joined by our chief investment analyst. Let me break this down for you using the actual data, because the headlines are entirely focused on the recent sell-offs and the leverage in the market. But if you look at the fundamental data, there are three real causes driving SanDisk's underlying business right now. First, there's a massive architectural shift happening in data centers worldwide. Second, we are seeing an extreme tightness in NAND memory supply across the board. And third, there's the development of a next-generation technology called high-bandwidth flash, or HBF. For those who might be unfamiliar with SanDisk's evolving business model, you can think of them as the company selling the essential picks and shovels during this massive AI gold rush. While everyone else out there is fighting over who builds the best AI software or the fastest compute chip, SanDisk is quietly providing the massive high-speed storage infrastructure that actually holds the gold, which is the data itself.
Wait a minute, Doctor. What does an architectural shift have to do with our stock accounts? I mean, look at this number, 726%. That is SanDisk's massive year-to-date climb. It officially makes them the absolute best-performing stock in the NASDAQ 100. But I have to be honest, when I see a number like 726% in a single year, my alarm bells start ringing loudly. How does a legacy storage company, one that was just spun off from Western Digital a little over a year ago, suddenly jump over 5,000% since that spinoff, and 726% just this year? It's proven by the numbers that this isn't just retail hype. What we are looking at is a fundamental structural shift in capital expenditure by the world's largest hyperscalers. You have to understand that AI's core objective is processing large-scale parallel computation. Doing that requires ingesting completely unprecedented amounts of data continuously. SanDisk's role in this massive AI build-out is foundational. They manufacture the advanced memory and flash computer storage. But if you look at the data here, it is specifically their enterprise data center segment that is driving this 726% stock explosion. The market is finally pricing in the harsh reality that you simply cannot run high-level AI programs without enterprise-grade data storage sitting right next to the compute layer. The faster the AI needs to think, the closer and larger that storage needs to be.
Okay, I hear you on the AI infrastructure angle and it makes sense, but an RSI of 99? OMG! For those watching, the Relative Strength Index operates on a scale of 1 to 100. Any reading over 70 is traditionally considered heavily overbought and potentially extremely overvalued. SanDisk recently hit an RSI of 99. Is this not the literal definition of a massive bubble waiting to burst? If you look at pure historical chart patterns, an RSI of 99 is indeed a technical red flag. It strongly indicates a rapid price correction risk. However, relying exclusively on technical analysis means you are trying to predict a stock's future based solely on historical trading data, which completely ignores the fundamental business transformation happening under the hood. The recent market adjustments we have seen, which were driven by sell-offs in South Korean semiconductor firms and rising concerns over AI infrastructure borrowing costs, have certainly put immense pressure on the stock. But the underlying multi-year supply contracts that SanDisk has secured remain firmly intact, and those contracts are what will drive the actual cash flow going forward.
Even Polymarket, which is that massive prediction markets platform everyone is watching, put out a statement calling SanDisk officially the most overbought stock in history. That is a pretty terrifying title for anyone holding this stock in their portfolio right now. Are the prediction markets completely wrong here?
It is a sensational headline designed to grab attention, but the data tells a very different story. Technical indicators like RSI absolutely do not factor in fundamental structural changes in a company's core product mix. The Polymarket quote completely disregards the fact that SanDisk is no longer just selling consumer thumb drives at big box retailers. They are currently executing a highly deliberate shift toward the highest value end markets in the entire AI ecosystem. This fundamentally alters their earnings power, their profit margins, and consequently, their appropriate valuation multiples. You cannot value a company building next-generation AI infrastructure the same way you value a company selling cheap flash drives.
So what you just said basically means while the technical charts are flashing bright red, the actual business is operating in a completely different, highly profitable reality. Let's unpack those three specific growth drivers you mentioned earlier. Precisely. The data shows three interconnected, fundamental drivers powering this valuation. First is the data center shift. SanDisk has moved incredibly aggressively into enterprise solid-state drives, or ESSDs, which are highly lucrative. Second is NAND tightness. Right now, there is an industry-wide supply shortage of high-quality NAND memory. This shortage is giving SanDisk incredible, unprecedented pricing power in the market. Third is the high-bandwidth flash weapon. This is their proprietary next-generation architecture that directly addresses severe AI memory bottlenecks. When you combine these three factors together, they have created an absolute perfect storm for unprecedented revenue expansion that we have never seen in the sector.
Let's look at that revenue expansion, because you brought the Q3 2026 earnings report, and these numbers are absolutely staggering. $5.95 billion for a single quarter?
Yes, if you look at the Q3 2026 financial highlights, their total revenue came in at $5.95 billion. That is up an incredible 97% sequentially just from Q2, and it represents a 251% increase year over year compared to Q3 2025's revenue, which was only $1.69 billion. Furthermore, they reported GAAP net income of $3.6 billion, or $23.03 per diluted share. To really put that financial swing into perspective, in the exact same quarter last year, they posted a staggering net loss of $1.9 billion. This is not just incremental standard business growth, it is a complete financial metamorphosis. This massive swing to profitability is being directly driven by higher pricing power across the industry and a shift towards significantly higher value enterprise customers.
Oh my God, really? A swing from a $1.9 billion loss to a $3.6 billion profit in just one single year. And looking at this chart, the data center revenue growth is clearly the engine driving that massive charge.
The numbers here are definitive and they speak for themselves. Data center revenue back in Q3 2025 was a mere $197 million. Fast forward to Q3 2026 and it reached $1.46 billion. That is a staggering 645% growth year over year, and it is up 233% just from the previous quarter alone. SanDisk CEO David Goeckeler accurately identified this as a fundamental inflection point for the entire business. Their technology leadership is enabling a deliberate strategic shift in their product mix toward the absolute highest value end markets available today. This explosive growth isn't consumer retail or everyday electronics driving this. It is massive enterprise hyperscalers signing enormous checks to secure the storage they desperately need.
Hold on, doctor. That's too complicated. Could you give a simple analogy? For those of us not actively building multi-billion-dollar data centers, what exactly are these hyperscalers actually buying from SanDisk? Let me break this down for you. Think of standard computer memory like a small, everyday filing cabinet in a local office. It holds a few documents, and it gets the job done for small tasks. What SanDisk is selling to data centers now are TLC-based enterprise SSDs. These are essentially massive, fully automated, high-speed warehouses for data. The Q3 report explicitly states this enormous revenue surge was enhanced by incredibly strong demand for their TLC-based enterprise SSD portfolio. This portfolio directly powers performance-intensive compute workloads, where speed and latency are absolutely paramount for AI training. Additionally, SanDisk is securing this massive revenue through what they call new business model agreements. These are multi-year customer engagements backed by firm, locked-in financial commitments. They signed 3 of these massive agreements in Q3 and 2 more in Q4, which effectively locks in long-term durable earnings power for years to come.
They are making good money, so why is the stock price like this? I mean, look at this table. SanDisk is trading at a forward PE of 34.7, while Nvidia, the undisputed king of AI hardware, is only at 23.3, and Alphabet is at 24.6. Why is the market going wild and pricing SanDisk at such an incredible premium compared to the absolute biggest tech giants in the world?
It is essential to look beyond just the top-line multiple and examine the underlying fundamental operating leverage of the business. Yes, a PE of 34.7 is undoubtedly rich, but it's proven by the numbers that the financial data completely justifies this premium when you look closely at their rapid margin expansion and their pristine balance sheet health. The market is aggressively pricing in the future commercialization of their patented technologies and their sustained triple-digit revenue growth pace. Let's look at the actual fundamental health of the company to understand exactly why smart institutional investors are more than willing to accept this high multiple.
Okay, show me the money. Are they actually fundamentally sound, or is this just paper profits built on accounting tricks? The financial statements are absolutely pristine. If you look at the Q3 2026 data, SanDisk currently operates with 0 debt on its balance sheet, which is incredibly rare for a hardware manufacturer scaling this fast. They generated an adjusted free cash flow of $2.95 billion in a single quarter, bringing their total cash and cash equivalents to a massive $3.74 billion war chest. But the most critical figure here,
the one that truly justifies the valuation, is the gross margin. In Q3 2025, their GAAP gross margin was 22.5%. In Q3 2026, it hit an unbelievable 78.4%. That is a 55.9 percentage point jump in a single year. When a company has zero debt, billions in cash, and is retaining over 78 cents in gross profit on every single dollar of revenue while growing at a triple-digit pace, a 34.7p multiple is entirely logically defensible.
So what you just said basically means they have an absolute fortress of a balance sheet, and they are pulling in profit margins that software companies would literally kill for. But wait, hardware is notoriously cyclical, right? Competitors like Samsung and Micron have massive factories and huge budgets too. What is the unique economic moat that protects this 78.4% margin from being eaten alive by competitors tomorrow? What exactly is their irreplaceable weapon? Their irreplaceable weapon is leading a fundamental, structural shift in hardware architecture. The broader market has finally realized that the major bottleneck in AI development is no longer just securing GPUs. The new bottleneck is memory capacity. To solve this critical issue, SanDisk has developed and patented a groundbreaking technology called high bandwidth flash, or HBF. This is the core technological differentiator that fundamentally reshapes the entire AI memory race, putting SanDisk miles ahead of traditional storage solutions.
Wait a minute, doctor. High bandwidth flash? I know HBM, high bandwidth memory, which companies like SK Hynix and Samsung make for Nvidia, but what exactly is HBF? According to the official patent documents and deep industry analysis, high bandwidth flash is a revolutionary next-generation structure. What it does is vertically stack non-volatile NAND memory and place it directly beneath the graphics processing unit or AI accelerator. Traditional AI chips are designed by attaching HBM next to the GPU and leaving the larger, heavier data to SSDs that are physically located much further away in the server rack. NAND generally has slower data access than DRAM, but by placing it directly under the compute chip, SanDisk's new architecture shortens the physical data travel distance dramatically. This directly eases the severe data bottlenecks currently plaguing AI semiconductors.
That's too complicated. Could you give a simple analogy? I'm having a hard time picturing how this physically works inside the server and why it matters so much. Absolutely. Let me break this down for you. Think of the AI processor, the GPU, as a brilliant student sitting at a desk trying to solve a complex math problem. High bandwidth memory, or HBM, is like an open reference book placed right in front of them on the desk. It is incredibly fast to read from, but it has very low capacity, it is expensive, and it's volatile. Volatile means when the power cuts out, the book instantly goes blank. Standard SSDs, on the other hand, are like a massive library located down the street. They hold everything you could ever need, but it takes way too long for the student to get up, go fetch the information, and bring it back. HBF, SanDisk's new technology, is like installing a giant permanent bookshelf directly attached to the student's desk. It provides massive, non-volatile capacity. We are talking 8 to 16 times the capacity of HBM, sitting right where the compute chip needs it, and it never loses its data if the power goes out.
Wow. So they are literally bringing the massive library straight to the desk. And looking at this patent, US 12430.274, this isn't just some theoretical white paper dream, really? They actually patented this? Yes, it's proven by the numbers and the legal filings. This diagram directly from the US Patent and Trademark Office, registered by SanDisk, proves this is a tangible architectural reality. It clearly shows a processor placed on top of a structure that perfectly integrates NAND storage and its specific control circuitry. This combined structure is then attached to an interposer, with traditional HBM arranged tightly around it. This fundamental redesign is exactly why the market is assigning such a massive premium valuation to SanDisk. They are aiming to elevate NAND from being just a simple, slow storage device at the back of the server to a high-capacity memory that operates directly alongside HBM within the AI semiconductor package itself. It completely changes the paradigm of the AI chip package architecture.
In other words, SanDisk isn't just making a slightly better, faster hard drive. They are literally redesigning the entire brain of the AI computer. But honestly, can they really build this massive shift alone?
If you look at the data, they clearly don't plan to do it alone. SanDisk has already formalized major HBF standardization work in a deep partnership with SK Hynix. Back in February, the two companies held a massive kickoff event for an HBF specification standardization consortium right at SanDisk's headquarters in California. This is a brilliant strategic move. SK Hynix brings their unparalleled expertise in stacking, packaging, and interposer technology, which they already perfected while dominating the HBM market. Meanwhile, SanDisk brings the ultra-high-capacity NAND and advanced flash design capabilities. This collaborative setup creates a massive, almost impenetrable barrier to entry for competitors. Think about it. If SK Hynix, which already controls Nvidia's vital supply chain for HBM, builds the official HBF standards with SanDisk, it essentially shapes the entire future AI memory market around their joint ecosystem.
Okay, I am sold on the massive upside, but I have to play devil's advocate here. There has to be a catch. Stacking massive amounts of dense memory directly underneath a blazing hot GPU sounds like a literal recipe for a server fire. What are the fatal risks here? The risks are highly technical, very real, and quite severe. As leading semiconductor researchers have openly noted, if you place a processor, a complex NAND structure, and an HBM stack into one single package, thermal control becomes extremely difficult. GPUs already consume massive amounts of power and generate intense heat. Adding NAND directly underneath raises the internal package heat density exponentially, making the power delivery network design incredibly challenging. Second is the risk of packaging yield drops. We are talking about 3D NAND with hundreds of microscopic layers combined with complex hybrid bonding. The process complexity skyrockets, which can easily destroy production yields and erase profit margins. Third, the software ecosystem must be rewritten to perfectly orchestrate what data goes to the fast HBM and what goes to the deep HBF. Finally, the massive macro risk. Competitors like Samsung are heavily rumored to be aggressively developing their own HBF technology. If Samsung solves this first and aggressively floods the NAND market, SanDisk's beautiful 78.4% gross margin could evaporate overnight.
So, what you just said basically means if they can't beat the heat, or if Samsung crashes the party, this whole 34 PE valuation comes tumbling down hard. Based on these extreme variables, what do the actual forecasts look like for investors?
Based strictly on the data and the current observable market environment, we can logically model three distinct survival scenarios for investors: a base case, a bull case, and a bear case. Let me break this down for you by looking at the specific preconditions or triggers and the real-world feasibilities for each of these three outcomes.
Let's start with reality. What is the base case? The most neutral, middle-of-the-road scenario based on what we know right now. The base case assumes the current macroeconomic data holds relatively steady. The multi-year, firmly committed contracts that SanDisk signed in Q3 and Q4 provide a very solid, predictable revenue floor. HBF technology moves steadily through the standardization consortium with SK Hynix, but it faces the normal, entirely expected delays in commercial deployment due to those thermal engineering hurdles we just discussed. In this scenario, NAND supply gradually normalizes across the broader industry. This means SanDisk's massive 78% margins might cool off slightly, regressing toward historical enterprise averages. But their overall revenues still grow steadily. The stock would likely stabilize, trading much more in line with traditional high-growth tech multiples rather than maintaining these extreme hypergrowth premiums.
Okay, but what if they actually pull this off? What if the SK Hynix partnership knocks it completely out of the park? Give me the maximum upside bull case.
If you look at the optimal triggers, the bull case requires SanDisk and SK Hynix to successfully overcome the thermal and packaging yield hurdles well ahead of schedule. If they successfully commercialize HBF and it rapidly becomes the standardized go-to architecture for next-generation AI accelerators, SanDisk instantly transitions from being a simple component supplier to an irreplaceable architectural partner. Furthermore, the edge end market, which already grew an incredible 118% sequentially to $3.66 billion, would see massive compounding expansion as AI PCs and next-gen smartphones adopt this premium, localized storage. As several top financial analysts have predicted in their recent institutional reports, successfully locking down this AI infrastructure monopoly could realistically propel SanDisk straight toward $1 trillion valuation by 2027.
Oh my God, $1 trillion. That is wild. But as investors, we always have to look at the dark side to protect our capital. What is the absolute worst-case scenario? The bear case. The bear case heavily materializes if the technological and macroeconomic risks align simultaneously. The data from platforms like Simply Wall Street already shows that recent market adjustments were directly triggered by growing fears of AI infrastructure overborrowing and unsustainably high valuations. If HBF fails thermally in real-world hyperscaler testing, SanDisk completely loses its irreplaceable weapon. Simultaneously, if Samsung unleashes massive, aggressive NAND capacity expansions to reclaim market share, destroying industry pricing power, SanDisk's gross margins will plummet right back down to the 22% range we saw last year. Combine that execution failure with a broader, macroeconomic cooling of AI capital expenditure by big tech companies, and SanDisk's 34.7 forward PE multiple will brutally and rapidly collapse, leading to a severe, highly sustained price correction. It is truly a high-stakes race between breakthrough engineering and macroeconomic gravity. It perfectly brings to mind Benjamin Graham's famous stock market quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Right now, the market is enthusiastically voting on SanDisk's incredible momentum and their 78% margins. But eventually, the market will weigh their actual physical ability to deliver high-bandwidth flash without melting the servers. So the ultimate question you have to ask yourself is, are you betting on a flawless engineering miracle alongside SK Hynix, or are you waiting safely on the sidelines for the smoke to clear? Thank you to our chief investment analyst for breaking down the actual data behind the crazy headlines, and thank you all for watching today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our Explainer production. We will see you in the next deep dive.